Ashley has left his seat. It looks like there he is, popped up out of nowhere. How you doing, Ashley?
It takes my camera a second to pop in. So
good to see you, just like a ghost. Hey, I'm going to turn the stage over to you, Ashley, but essentially I want you to go through, and I think Graham's going to cover some of the nitty gritty about OZ fund formation or some technical details there that you find particularly salient lately. And
Graham's going to be showing number crunching and how you should be looking at IRRs versus gross equity multiples, and how that kind of plays out into a spreadsheet for
fantastic.
all of the spreadsheet geeks out there. Graham is he's one of the head spreadsheet geeks that I've ever met. So we're excited about having him talk about that.
And then you're also going to be discussing successful opportunity zone investing tactics as well, I believe, right?
That's exactly right.
Good.
And we could go ahead and jump into that while we're waiting for Graham to get his video back and going and that kind of thing.
Sure.
I'm gonna jump over to this screen, and for those who have heard me or taken the course or anything like that, this is opportunity zones on a page. And it wouldn't be an Ashley Tison session without opportunity zones on a page. And so one of the things that I want to talk about, I want to talk less the kind of in the weed logistics. We've got a course out there that's available for that is available on the website if you just want to take the course. We've also got the OzWorks group, and that course is embedded inside of the OzWorks group. And we've actually got inside of that kind of updates to the course and some of the stuff, the hot topics that are happening, kind of inside of the space. But what I wanted to do today, Jimmy, is talk about specifically like some of the stuff that we've seen. And I think we're approaching 500 strategy calls at this point. And we've talked to almost 500 people, 500 different, opportunity zone investors, fund managers, business operators, towns, EDA people. So it's been really cool to have the opportunity to be able to connect with that many people and to see a ton of deals and to see the way that people are looking at these things. And, I wanted to highlight a couple of those relative to how they made the decision relative to their tax approach and how that factored into ultimately how they structured their deal. And before that, I want to kind of go over this kind of with just best practices that we've seen people do, right? So this is opportunity zones on a page that everybody has to comply with. Now, and this kind of goes into Chris's comment, is that we've seen kind of two schools of people. We've got the folks that are interested in, going into, a professionally managed fund, but then we've also got folks who have used our done for you service, or they've set it up themselves, or they've called for us to help them to kind of do their own projects. And so we saw a big push of that, and we see a big push of that as we come into the deadlines, because number one, it gives people time to get their money into the fund and then to be able to make a decision. So, the principle is that you have to have a capital gain. So it's got to start with a capital gain, and that gain's got to get into a fund within 180 days of the gain, or 180 days from the partnership tax filing deadline if the gain came through a partnership or an S corporation. And so for the people that are sitting 180, and certainly as we go into the end of this year to get that 10% step up in basis, we are already seeing a spike of people just going ahead and getting this done, getting their opportunity fund set up, getting it positioned with a bank account open so that way it's ready to roll. If you wait till the end of December, right, and we've had this happen numerous times, the IRS shuts down the ability to be able to get EINs starting around Christmas Eve. And so if you don't have an EIN, you can't get a bank account, and you will not be able to put your money into it. We've got some shelf funds that we've specifically set up for this, but as you can imagine, because it's extra work, it's a little bit more expensive. And so if you're thinking about doing this yourself, if you're in that category where you're like, hey, I want to do this myself, the successful investors and the people that we've seen do well with this are going ahead and pulling the trigger on getting that set up so that way they can investigate the best banking relationship for them, the best approach for how they're going to handle their treasury management, that kind of thing. So once your money is inside of a QOF, there's a couple of things that we're seeing that folks are doing well, right? And the biggest one on that is getting their professionals educated and making that happen prior to tax season. because there's a lot of professionals out there that don't understand this test, right? That 90% of your fund assets have to be held in qualified opportunity zone property as measured on 2 dates, right? That's the last day of the first 6-month period and the last day of the fund's taxable year. So what this effectively means is that if you set your fund up and you establish your fund between July 1st and December 31st, your first testing date is going to be December 31st. Now, if you bring money in, you get to disregard any money that came in during the previous 6 months for that asset test, right? If it's still held in cash or cash equivalent, which is a loan of under 18 months or less. So what that then does is kick your testing date to the June 30th of next year. So if you brought your money into a fund prior to June 30th, your first testing date would be 6 months out from whenever you started that fund. So it'd be July 15th or August 15th, according to when you elected that it was going to happen and when you dropped your cash in. Now you go and effectively you map that out 6 months. Once again, you get to disregard the cash that came in during the previous 6 months. And so what that does is that kicks your real testing date to December 31st. And so if you set up your fund prior to July 1st, so if you did it, earlier this year, your first testing date is going to be December 31st. And let me tell you, the opportunity zone professionals are going to be busy in December. And so if you need to do an asset test, you're really, the successful investors are getting that stuff done now while people have bandwidth and they've got, summertime and that kind of thing, where they're not heading into the October tax filings. And then they're not also getting into kind of the year-end tax planning. So the successful people that we've seen give themselves plenty of lead time. Now we can get it done last minute, but it just becomes more stressful for everybody. The other thing that they're doing is they're lining up legit professionals. And if their accountants that they prefer to use aren't, really all that knowledgeable about opportunity zones, they're plugging them in with CPEs. So we've got a CPE that's actually, I think it's available through Ozworks Group. And also they're setting up strategy calls with their CPAs so that I can walk their CPA and Graham can walk their CPA through exactly what needs to be done. Then if their CPAs are kind of out to lunch and there's not a possibility of being able to do that, we've got some great recommendations and we've got some great partners that we can plug folks into. And so experts are a game changer. So the other piece that we're seeing, and this kind of goes into that whole kind of thing as well, when people drop their money into the QOF, they then come in on this testing deadline. Well, the easiest way to hit that testing deadline is to drop the cash into a QOZB, whether that's your own self-directed QOZB or whether that's a professionally managed one that is allowing direct investments directly into their QOZB. So one of my favorite examples for that is Hall Venture Partners and Hall Family Labs. So they are a fund, so they've got their overarching fund, but then they've also got portfolio companies underneath that are then available for direct investment. And a couple of their portfolio companies are actually probably going to end up exiting before 10 years. And so smart investors understand that you can put your money into a QOF, you can then make an investment into a QOZB, and even if that QOZB exits and returns your capital, you've got 12 months to reinvest that basis into another QOZB. And then you've also got that same window relative to the capital gain to reinvest that piece. So we've seen a lot of activity of folks doing that. And then we've also seen people investing from their QOF directly into other development QOZBs and kind of smaller companies, almost in the form of kind of a direct investment. And when you do that, you're going to want to make sure that you get a covenant from that QOZB that says, number one, that they're going to comply with all 5 rules of the QOZB. So you're going to want a covenant from your QOF that coincides with your investment into that QOZB that they're going to comply with that. And then the second thing that you're going to want to get in the form of a covenant is that they're going to get you the information that you need in order to complete your 8996. Whether this is an individual fund or whether this is a professional fund that's being managed, that's the thing that they're structuring into their investments now, because you've got to delineate the track number, the opportunity zone track number, the census tract, the EIN, that's easy. But then the value of the opportunity zone stock or partnership interest as of the 6-month mark and as of the year end mark. And then, and this is the one that's significant and involves a little bit more detail and a lot more testing and a lot more due diligence and informational gathering, is what's the value of the owned property and of the leased property as of the 6-month mark and as of the 12-month mark. And so that can be a little bit daunting for people that aren't, used to kind of going through this exercise. And so we're plugging people within with professionals to kind of assist with that piece, but also to walk through, okay, what kind of covenants and documentation that we provide for them to make that happen. So I'm going to go through kind of a case study illustration as well to talk about this. This has come up an enormous amount, right? What's going to happen with capital gains, and what rate am I going to pay when I pay the taxes on this? So once again, you get to defer your taxes, right? Once you drop your money into the QOF, and Graham's going to use this slide too, you get to defer those taxes until December 31st, 2026. If you're invested for 5 years, right, you get a 10% reduction in the taxes when you go to pay them when they become due December 31st, 2026, if you've held for 5 years, which means that you have to be invested by 12/31/21. And so what we've seen people doing is, right, we've got people that are exiting and they're saying, we are pretty convinced that capital gains rates are going to go up. So we're actually trying to exit right now so that way we can get locked in at that 20% rate. And so I regularly have a conversation with them to say, it's nice and it's great, but even if they are successful at raising up the capital gains rate, to significantly higher than, what they are now, you still have the 10% reduction if you get it in this year. And then to their point that they were making on the previous presentations, is that 10% reduction, right, that happens is significant, but then also you're able to get a return off of the government's money that you're holding on to for the next 5 years. So even if the rates are higher, it tends to mitigate that a little bit. But once again, a lot of it just depends about people's minds. So we go through this analysis, we go through this conversation, but I've seen 2 separate ways that this has been handled. So we had a gentleman that sold his business and he generated around $3 million. I think it was like $3.8 million of capital gain. And so he set up his own fund and he's putting that into a QOF, his own QOF. He's already seeded it in. He got it in before the 180 days. And so now he's on a window to figure out what he's going to do with that money. And so he has an opportunity to basically be the investment capital for a fast food franchise that is going to ultimately be built down in Pembroke, so down in the eastern part of North Carolina. And so it's actually kind of a cool restaurant concept. And I wish that I could tell everybody what it was, but it's neat. Go to Pembroke and check out the newest restaurant, and you'll get a kick out of it. So what he decided to do was, because he had $3 million to stick into it, he decided that he wanted to go ahead and use and exhaust all of his cash. So this development deal, so the actual this building was like right around $2 million all in. And then he's got another building that's adjacent to it that's right at $2 million as well. And so it's an aggregate $4 million spend, and he's doing it all in equity. So he's taking all of his cash and he's putting it into these deals, and he's keeping it inside of his QOF. He's not paying any taxes, and he's counting on the ability to be able to refi this in 2 years and be able to pull out his cash so that he can put it into the market and do some other stuff with that. Now, what's really fascinating about that, and we went through this entire exercise in the course of the model and stress testing the model, is that when you do that, even with the cash out refinance in year 3, it still drags the IRR down, because it's calculated about when you're getting your money back, right? And so if you're not using leverage up front, so number one, he can't take the depreciation until he has leverage that's going to allow him to take that depreciation and take it up, right? And so there's a couple of things that increase outside basis. It's one, a loan, or the thing starts making money. But he decided that he wanted to just go ahead and do this so that way he had his money invested and it was qualified, and then he's planning on taking it out via a refinance. So that analysis, and because he was not using debt on the front end, his return is actually not, it's not as robust as some of the market rate returns that, a lot of the funds are talking about here, because he's not using leverage. And so that's another conversation that factors into what the returns look like. We had another gentleman that had a similar capital gain. He had, I think it ended up being around, it's not similar, I think he had around $10 million of gain. And he's got the ability to be able to deploy all $10 million of that into a deal that he's working on. And I think that the deal is like I think it might be let's call it a $20 million deal, right? A full development. So he could bring his $10 million and do the exact same thing. But what he decided to do instead was he said, you know what? I know that I'm going to need roughly 10% as capital, as equity in this deal. So I'm going to only put $2 million into my QOF, and I'm going to then drop that down into my QOZB. And I'm going to use that as the equity because I'm getting an outside loan for the balance of the 18 million. And his thought process on that was, hey, I have a chance to pay taxes at 20% now. I'm going to go ahead and pay them while they're on sale. And so he was like, I don't want to soak my money into this because I'm concerned about interest rate risk on the refinance on the back end. And I'm also concerned that stuff could happen in the interim between now and 3 years out. And so he decided to put the minimal amount of equity in because he's ultimately still going to get the same step up in basis to fair market value after a 10-year hold. So one of the things that Graham does on strategy calls, and we'd like to welcome Graham to the team. He's been a fantastic addition. Graham specifically does pro formas and does modeling to look at exactly these kinds of conversations. So Graham, I think that you were going to walk people through that.
Yeah, sure.
Start from this slide and kind of explain some of the other pieces that are there. And I think we've got about 4 minutes because I want to turn this over to questions.
Yeah,
and
sure.
You tell me when to advance the slide.
Sure, go ahead. So of course, Ashley covered the 3 benefits. We want to be able to show those on a page. Let's go ahead and go to the next slide.
Yep.
This is what we do for our clients is to help take the mystery out of where these benefits really hit the P&L, what investors can expect. So this would be roughly a $5 million project where we, as Ashley indicated, you're levering up a $1 million capital gains investment into a QOF for a $5 million deal. In this particular investment, this is paying a preferred rate of 10%. You can see that in the calculation of the AR, the second level, incremental from disbursement, 7.944. That's about $28,000 per quarter. Of course, that if you see just below the million, you'll see the tax benefit from the step up in basis, the 247, and then the NIIT. So that $285,000 is deferred. So that's really like a 0% loan that's going into this project until you see 430.
Actually, it's a negative interest loan, Graham, because you're getting a discount when you go to pay them. Well, that's presumably if they don't jack up the rates.
That's true, potentially. Correct, actually. So what we show here is we show the preferred rate of return here. So this is the 28 per quarter with so roughly 36 disbursements over a 10-year period for this investor. We show that in April of 2027, they're paying their tax to 257 rather than 285. And so there's that 10% step up in basis, and that's where you track that. And then when you go to the back end on 7/31 of 31, in this case, we have a project that doubles in value. So we have an initial 1 million in, and the investor would take 2 million out. So that is that tax-free, really a magical tax-free exit, because when we go below that, you see that $285,000 tax is foregone there. And so that is really like a $1.3 million benefit on the back end versus the 1.0 million. And so when we see what that does to the internal rate of return, we have if we go to the calculations, we have our investment IRR. So we're doubling in value over 10 years, 7%. We have our 8% pref at 28 a quarter. And then the other benefits kick in. So we see that's a 15% base case. What we see when we add the opportunity zone benefits is this boosts the IRR to 19.8 in this case. And that's at 20% long-term capital gains rates. This is for an Ohio project paying 4.797%. and the 3.8% ACA tax, the NIIT. So with what we have here is we have 1 million in disbursements over the 10-year period, and then we have a $2 million exit. And what we see is, so that is an equity multiple of 3.01. All right, so there's triple your money on this. And what's interesting is, really the difference between equity multiple and IRR, what can be done to increase IRR. And while it traditionally is not looked at in calculating internal rate of return, but depreciation is not recaptured in opportunity zone benefits in that. And this is really a strong case. So on this particular project, we did something called a cost segregation study, which enabled us to expense a great deal of the investment, which pushed about $1.06 million in depreciation into the first year of the project on that $5 million deal. And so really, when we look at the actual after-tax cash flow, that's about $366,000. So the first $366,000 off this deal can offset the disbursements that are sent back to the investor, which if you're an investor paying the top rates plus your state rate, in this case of 5%, you're really looking at nearly doubling your money effectively for the first 3 years of this investment. So that all in, exactly. Thank you, Ashley. So really, this is where we see it. If you go to the next page, Ashley, so this is where we should really compare a nosy investment.
In this one?
Next one, page 5.
Yeah, I didn't have a page 5, so
Okay.
sorry
Okay.
about that.
No problem.
We'll have to send it around to everybody. Apparently, I mucked up the slides.
I can see it. It's okay. So, well, really, what we see is opportunity zones add between 1/3 and 50% to the base internal rate of return, and we've seen that across deals across the country, different markets, different verticals. It can work for an IT firm, an e-commerce, real estate. It really is a once in a generation incentive, but really where the rubber hits the road is all the compliance that Ashley mentioned, and making a deal, make sure it works. You don't want a surprise in 3 years that something was non-compliant. But really, yeah, but go ahead.
Yeah, so let's jump into the questions. One thing that I wanted to point out too, Graham, that you've got in here is that Ohio is a conforming state. So you're getting that, and I think that you worked that into your deferral numbers up here.
That's correct. That's correct.
So we had a question, and there was a question in the chat, I think, from one of the previous sessions about what happens if you set up and you're you're a resident of a conforming state now. And you move. And so I know the exact answer to that question, because North Carolina, which is crazy to me, is a non-conforming state. But, and so accordingly, if somebody's doing something that's going to be outside of North Carolina, where you're not just going to have property taxes that you're going to have to pay one way or another. So if you're doing a real estate deal in a state, you're probably going to end up paying the state income tax on that. But if you're doing a deal that's an investment that's outside of your state, that is the non-conforming state, you can effectively set up a fund in a different state and then be able to, to move prior to the 10-year hold. And then ultimately, that's going to be affected by how interested your state is in coming up with how much, was accreted during your residency there. But it gives you a lot better argument and a lot better possibility that, hey, the value of this thing was on the back end after I moved out of the state that's non-conforming. And so I should not accordingly owe state taxes, even though you're trying to get in my pocket. And so that a lot of times that's what we're doing for folks that are in non-conforming states. We're specifically setting them up funds in conforming states, so that way they've got that flexibility on the back end.
Yeah, if I can just say one more thing about Ohio too. Ohio even offers an opportunity zone tax credit program where they offer, I'm just reading it right now here on my other screen. It says the taxpayer who invests in an Ohio opportunity zone is eligible for a non-refundable tax credit equal to 10% of the total of its funds that were invested in the property. Essentially free money from the state of Ohio there, if I'm reading that correctly.
That's correct.
Actually, Gary in the chat or in the Q&A had a very similar question. So I think we've had this question come in twice today. He wants to know,
so you're going to pay the tax.
He's moving to Nevada. Go ahead.
Yeah, so he's going to have to pay the taxes in California this year. It's not going to defer it because it's a non-conforming state. So what ends up happening is on a real estate deal, it actually gets withheld, and you go ahead and pay it, and you pay it in California. But on your new investment,
he can defer the federal
correct.
taxes on that initial gain, but California, you pay it. You have to recognize it this year, payable April of next year, correct?
Correct. And so then if his new fund was, let's say, a Nevada fund, and he does a real estate deal in Nevada, and he moves to Nevada sometime between now and a 10-year hold when he's going to exit after the 10 years, then that's going to be up to him and how much he thinks California is going to chase him down for that. And obviously, the closer you get to that 10-year hold, right, as a state and a resident of California, the better their argument's going to be that they're entitled to some of that. And so, that's just something to weigh into your consideration. And ultimately, that's going to be a conversation for you and your accountant about what he's comfortable in filing on the tax return.
Sure. So question from Lucy here, going back to your restaurateur example. She wants to know, does that person have to own the restaurant 100%? What happens if someone else already owns it and you just want to sell 30% ownership, let's say via the OZ?
Yeah, so if you're investing into a QOZB, that's absolutely fine. Now, if it's actual dirt, so these guys were actually investing into the building itself. So they were building the building, and then they were going to lease that building to the restaurant operator. He's actually an investor in the operations business too, which bolsters his claim that it's not a triple net lease. That's one of the things that you got to be careful about, is that triple net leases are not eligible because the IRS treats them as investments. And so he's been really careful to structure that lease to where he's actively involved in the management of it for that real estate piece. But you could absolutely buy a piece of the operations for a QOZB restaurant that's doing business in an opportunity zone. You just need to make sure that, once again, like we talked about, that you got covenants that they're going to continue on as a QOZB, and that they're going to get you the information you need in order to fill out your 8996.
Right, good. So we've got time for a few more questions here. I'm going to cut this off.
Let's talk about, so I've seen some
7 or 8 minutes.
non-conforming, and while you go through the other ones, I'll take them off.
Yeah, go for it.
California is non-conforming. Mississippi is non-conforming. North Carolina is non-conforming. It's Massachusetts that's non-conforming as well. And then New York has got legislation that's pending to make them fully non-conforming. And so right now they are conforming, but I think that legislation has a good chance of going through. So they will ultimately be the fifth state that ends up becoming non-conforming.
That's right. So a couple of these questions came in earlier in the day. I was hoping I could hit John Sharetti from Novogradac, who was on my morning panel with some of these, but I've been holding them till now. I figure we'll throw them at you now, Ashley. Okay, so somebody asked earlier this morning about one of your favorite subjects, cryptocurrency.
There we go.
This person wants to know, this person says, hey, I understand entities created within an opportunity zone have requirements related to the percentage limits of cash holdings, right? Non-qualified financial property, or NQFP, as you and I like to call it. However, could the entity hold other assets such as cryptocurrency, such as a business entity operating and employing staff within the OZ and in providing services within and outside the OZ? Is there any guidance surrounding holdings of assets outside the OZ? Could cryptocurrency arguably be an asset residing within the OZ?
Yeah, so we've debated this ad infinitum, ad nauseum, as to whether or not cryptocurrency is non-qualified financial property or not that would fall under this test right here. And it then becomes an issue, and the biggest issue of what kind of crypto are you planning on holding? If you're just planning on buying Bitcoin or Ethereum or something like that, I think that the IRS would have a great argument that constitutes non-qualified financial property. Now, if you are generating cryptocurrency in the course of your business, that's a legitimate business that has employees and that hits these tests, right? So 70% of your assets are in the zone, and then 50% of your gross income is coming from employees that are located in the zone, right? So basically, you're paying at least 50% of your total comp to people that are working in the opportunity zone. Then I think that you've actually got a better argument that the crypto itself is an intangible asset of the business, and it's not going to be considered non-qualified financial property. But once again, you got to have some kind of legitimate business use for it. Otherwise, I think that the IRS has a really good claim that that's either excessive non-qualified financial property, or it's excessive inventory that you are maintaining and that you're keeping on hand, basically just to instead of holding cash, you're holding inventory that is, that you're planning on ultimately selling, not through your trade or business. So then that becomes the question: what kind of business is it, and what kind of social impact are you having within that business? And that's what I continue to talk to people about within the crypto space. If you're just looking to slap a bunch of miners in and make a bunch of money mining crypto, I don't think that's going to fly. I think that that's even could be substantial abuse. But if you've got a story where crypto is a part of how you're teaching, business owners how to do business, and you've got an incubator, accelerator, and that kind of thing, where you've got employees that are working inside of the zone, I actually think that that's a really good, compelling story. And if it just so happens that your business that you're teaching people about happens to be in the crypto space, I think that that's legit. And so then there's some strategies about, okay, how do we then, raise a fund so that we can deploy crypto and make investments into these QOZBs that we're starting and that we're growing inside of the zones. And once again, it's a little bit nuanced, but I think that if you head in that direction, I think that there's a legit way that it can be done. If you're just looking to mine crypto or hold crypto, I don't think that that's a very wise play.
Good. Great answer there. Hang on, I'm multitasking here. A question from Kenneth from earlier this morning wants to know about someone who already owns land in an opportunity zone. What are his options? So his question is, can a landowner sell out to an opportunity zone fund and still participate with the new fund owner?
So if they have capital gains from another source and they're not going to own more than 20% of the project, yes, right? So if they're if they're taking the capital gains from that sale and planning on reinvesting it into that deal, that's a no-go. That's no dice. The IRS said that was a step transaction. If they are, if they're planning on contributing the land into the deal, that's going to make it so that the land could potentially be a non-conforming asset because it wasn't purchased for cash, right? Which is one of the requirements. And so one of the things that we're doing regularly with people that are owners in opportunity zones so that they can participate is, if we need to sell it and they need to, they can then take the gains and they can put them into another fund, right? So that works. Especially if they've got other capital gains that we could plug into their investment into this deal, right? To the deal that's going to be on their property. But the other play is that we are just like, listen, let's structure it however we want, and we're just going to make the dirt non-conforming. We don't care about related party rules. And so by having the dirt be non-conforming, it gets kicked into the 30% bad asset store, right? So inside of your test, you get 70% good assets. And so you've got a 70-30 good asset store and bad asset store. And if you just put the land into the bad asset store, right, then if you're going to do improvements that are going to be in excess of 70% of that amount, then that's going to jive and it's going to be okay relative to our 70-30 test and it becoming good property down the road. Now, what you got to be careful about though is that during the period that you're improving it, that land is still a bad asset. And so if you own it in the fund, that can mess up your test because it doesn't count as a good asset. Now, there's a substantial debate going on about if you're during your working capital safe harbor, if you get a gimme on the 70-30 test. But the smart money's on, hey, let's go ahead and meet the 70-30 test while we're in the working capital safe harbor. So let's ground lease it, or we'll basically lease it from the people while we're doing the improvements. And then we'll buy it as soon as we get to that 70-30 threshold.
Excellent. We got time for, let's do like 2 or 3 more minutes. 2 more questions for you. Philippe wants you to review again the restrictions on the investment what and where for that up to 10% that did not get invested into an OZ project. Can you?
Yeah, Philippe, this is one of my favorite conversations. So that the folks that want that Bitcoin, right? I mean, this is where you drop the Bitcoin in, because inside of the QOF, right, you've got a 90% test. And so up to 10% can go into whatever you want. Now, I would not recommend putting it into something that you're planning on trading. So put it into something that you think is going to increase in value over the next 10 years, because when you sell that asset after a 10-year hold, you're going to get the step up in basis to fair market value. So beach house, mountain house, property that's outside of the zone, right? Whatever. I mean, once again, you know, it can only be up to 10%. And I would not go to full 10%. I'd go underneath it so that way you've got some wiggle room. You know, the other piece of this is that you also got to be cognizant that you may need, you know, to pay fees and such out of your QOF. So just be cognizant about that, because you may want to leave some cash in it so that it could pay expenses and that kind of deal. And so be careful about how much you plug into the deal. And you're not going to want to trade it, because if you trade it, the capital gains that come off of the growth of it are going to be taxable at that point in time. And so you then have to reinvest and do the whole thing, right? So I have conversations with people about that all the time. Stick it in whatever you think is going to grow in value substantially over 10 years, that you're okay just locking and loading.
So sin businesses, this question just came in. Sin businesses refers to racetracks or other gambling facilities. This attendee wants to know, does an auto racing track qualify as a sin business? I think they're just referring to horse racing, but what's your take on that?
So yeah, there's not been any guidance on it. So the clear language in and I don't have the actual language about the sin business, but and it says racetrack, comma, gambling facility. And so it's like, okay, is that a racetrack gambling facility, or is it any kind of racetrack at all? And so I think you got to be careful about that you probably should go straight to the IRS and see if you can't get a private letter ruling from them, or at least, you know, a comfort letter that says that, yeah, okay, racetracks are okay. Or, you know, go to a reputable law firm and get them to give you either a comfort letter or an opinion letter. If I was raising money to build a racetrack, because of that language in there, I would want an opinion letter from a really, you know, a reputable law firm in the opportunity zone space, that they said, nope, this is specifically tied to just gambling stuff, and that auto racing tracks don't apply. I don't understand why auto racing tracks would apply. I'm a huge NASCAR fan. That's not a sin business.
Yeah, I don't think that would apply. That's my opinion, but I'm not with the IRS, so I agree with Ashley. Go straight to the source. Hey, final question, and this will lead you into your call to action, I believe. Also, Ashley, David wants to know, he's a licensed real estate agent since '96, working with investors. He's interested in forming a QOF and providing fiduciary representation to the QOZB business or entity. Where can folks like David or others out there who are interested in working with you go to learn more?
So ozpros.com, and that's going to take you to where you can schedule a strategy call with either Graham or I. If you go to ozpros.com/save50, then that pops up a link for a discounted call with me. And we're working on trying to get that done with Graham as well. But you can find strategy calls with both myself and Graham, and we talk exactly about that exact thing. So we answer all types of opportunity zone questions. We run through strategies, we run through numbers, we run through basically whatever you want, right? It's your hour of time. If you want to talk baseball, I could do that. I'm not very knowledgeable about baseball, but hey, it's your time. And so we specifically help people look at the process. Okay, so what's involved in the QOF? What's involved in the fiduciary process? What's involved with raising money? How do you go about that? How do you look at distribution strategies? How do you go about raising investor awareness? What are those things that you got to do in order to execute to be able to get this program rocking? Because that's what all of us want. We want folks just like yourself to be able to do these deals on Main Street America.
Fantastic. Well said, Ashley. I'm going to cut you loose there and get our next presenter on board. But Graham, Allison, Ashley, Tison from OZ Pros, thanks for joining us today. Appreciate your time.
Thanks, Jimmy. Appreciate you always.
Thank you.
All right, take care, guys.
Cheers.